In this video we are going to talk about dividend stocks to buy and hold forever. So before starting, please like this video and subscribe to this channel for our future updates. Some frantic traders believe that holding a stock for a year or two qualifies as long-term investing. For many first-time investors though, a year or two is simply the beginning of their adventure. After all, there has been a lot of research done on the dangers of trading too much and either underperforming or simply increasing your costs in fees and taxes. Following the advice of investment legend Warren Buffett, who famously joked at a Berkshire Hathaway shareholder meeting that our favorite holding term is forever, is a much better option. Consider the following dividend stocks to buy and hold indefinitely if you're looking for a long-term investment. The next 9 firms are all worth more than $100 billion and offer above-average current yields of more than 2%, as well as long-term stability. Number 8. Pfizer Incorporated, PFE. As a result of the success of its COVID-19 vaccine, which is currently market leader, PFE has earned a reputation for itself in recent years. A healthcare behemoth, PFE is a pharmaceutical behemoth that possesses the necessary competences to retain its competitive position in a variety of market environments. Additionally, aside from the pandemic, the company's existing bestsellers, like as the Prevnar pneumonia vaccine, the Ibrance breast cancer drug, and the Eliquis blood thinner, continue to generate good long-term profits for its stockholders. When it comes to life, there is one thing that is certain: we will all grow old and fall ill at some point. If you are a dividend investor looking for a long-term investment opportunity, a firm like Pfizer, with its good track record and extensive global reach, is a fantastic long-term alternative to take into account. Number 7. McDonald's Corporation, MCD. In addition, MCD acts as a case study in a firm that understands how to maximize long-term shareholder value generation while simultaneously serving as a symbol of the restaurant sector, as demonstrated by its success. According to the firm's financial documents, the dividend of the corporation has climbed dramatically over time, with at least one dividend increase per year for more than 40 years in a row. As evidenced by the magnitude of the increases, a quarterly payout of 61 cents per quarter in 2011 has more than doubled to a payout of $1.29 per quarter now, representing a more than fourfold increase. In spite of the increased emphasis on healthier eating among the general public, consumers continue to be drawn to the McDonald's menu, which is both cost-effective and always convenient for them. With the company's recent growth into delivery and the implementation of a customer loyalty program, you can expect this stock to continue to maintain its excellent track record for the foreseeable future. Number 6. Cisco Systems Incorporated, CSCO. As the market capitalization of Cisco reaches $232 billion and the company establishes itself as one of the industry's dominant forces, it is the $232 billion market leader in enterprise computing. Cisco was founded in Silicon Valley in 1984 and is headquartered in San Jose, California. The company has survived a number of missteps along the way, including some bizarre forays into consumer technology with products such as its flip camcorder, but its business has grown, and with it, the company's dividend payout has increased as well. With respect to the company's dividends, they began at 6 cents per quarter per share in 2011 and have increased significantly over the last decade, reaching 37 cents per share in 2021. Additionally, the company is riding high right now, having set a new 52-week high in September and appearing to be on the mend for now despite the fact that it operates in a sector where long-term viability is not in question. Number 5. Verizon Communications Incorporated, VZ. When it comes to investments on Wall Street these days, Verizon is likely the closest thing you'll come across. A massive scale is exhibited by the company, which generates more than $130 billion in annual revenue from millions of wireless, broadband, fiber optic, and cable television connections. As a result of the extremely expensive and highly regulated nature of building a telecom network, it has a near duopoly in the United States with fellow telecom behemoth AT&T Incorporated, as well as a high barrier to entry for any future competitors. In addition, VZ is only paying out about half of its operating profits as dividends, so even if the company does not grow in the future, there is plenty of room for future dividend increases to be made. Most people do not doubt that Verizon will be around indefinitely, unless they expect the entire global communication infrastructure to collapse at some point in the future. And if that happens, you'll be dealing with much more serious issues than your retirement account balance. Number 4. Coca-Cola Company, KO. Warren Buffett's favorite stock, KO, has long been a favorite of his, and with good reason. While sugary soft drinks may not be as popular as they once were in an era of more health-conscious consumers, Coca-Cola isn't exactly suffering right now, with a market capitalization of more than $230 billion and annual revenues of approximately $40 billion in the United States and other countries around the world. To make sure it remains relevant for many years to come, KO has expanded its product line beyond its trademark Coca-Cola soft drinks to include juices, teas, and hydration goods such as Powerade and Smart Water. Also noteworthy is the fact that it has experienced about 60 years of consecutive dividend growth, providing assurance to income-oriented investors that they will be rewarded as long as they stick onto this stock for the long haul. Number 3. Procter & Gamble Company, PG. Procter & Gamble is the corporation that is responsible for some of the most well-known consumer brands on the planet, such as Gillette shaving tools, Pampers diapers, and Crest toothpaste, to name a few examples. Chances are you have some Procter & Gamble products in your medicine cabinet or dresser drawer, and chances are even better that you will purchase more of the same tried-and-true brands the next time you go shopping. During the past 65 years, Procter & Gamble has boosted its dividends at least once a year, and the company has been in operation for just shy of 2 centuries at this time. Despite the fact that consumer staples distribution is not a high-growth or glamorous company, it is a solid one for investors who are wanting to expand their portfolios over the long run. Number 2. Johnson & Johnson, J&J. J&J, which was founded more than 130 years ago, has a long and illustrious history and is a well-known brand in the healthcare industry. When it comes to consumer-focused products such as Band-Aids and Tylenol, lucrative oncology drugs, or best-in-class digital medical devices for operating rooms, this healthcare behemoth has a lot going for it, according to analysts. Perhaps the most striking fact of all, however, is that Johnson & Johnson have the financial strength to back up its brand recognition and authority. Consider the fact that, along with Microsoft Corporation, MSFT, Johnson & Johnson, J&J, is one of only 2 AAA-rated stocks in the United States when it comes to debt ratings. Alternatively, the fact that the company has increased its already generous dividend once a year for a total of 6 decades is noteworthy. In terms of long-term investments, it is difficult to find a better option than J&J. Number 1. JP Morgan Chase & Company, ticker, JPM. JP Morgan Chase & Company, the largest of the big banks and a financial powerhouse, is not going anywhere anytime soon. BBVA Compass is a full-service leader, providing consumer and small business banking, as well as wealth management and high-end services to corporations and institutions. To put it another way, as long as there is money, JP Morgan will be there to assist people in making transactions, and will take a little percentage as a small charge for the privilege of doing so. To avoid worrying about the long-term consequences of a global financial crisis, it's important to remember that JP Morgan Chase fared much better during the 2008 financial crisis than many of its peers, and the company continues to be one of the best-run financial stocks in the world, thanks to the shrewd leadership of CEO Jamie Dimon. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.